Welcome to another episode of Simplified. I'm your host, Fred Martinez. Today, we're going to go over the game changer, an S corporation. Did you know that the chances of an audit of an S corporation is 15 times less than a Schedule C? What are some of the requirements of an S corp? Basically, you get the same structure as a C corporation. You have the same documentation to set up and maintain, and then you have the same asset protection. But you know what my favorite part of the S corporation is? Yep, no double tax. An S corp is what is called a pass-through taxation entity. This flows to you individually. Some will argue that the corporate tax return is fixed at 21% compared to an individual tax rate, which is 37%, but they may be wrong. However, when you receive a dividend and take W-2 wages, you will then have to pay taxes on it, and this is where you get double taxed. Now let's compare this to a sole prop, which is basically an LLC. It can be a sole prop and or an LLC. So let's pretend on the Schedule C, the sole proprietor makes $100,000 in net income. He's going to have to pay 15.3% in self-employment tax, which is going to be $15,300. When we work on the income tax return, he's going to do married filing jointly on the 1040. We're going to put the net income on Schedule C, and that's going to be $100,000 there. And then we're going to do less. The standard deduction in 2025 is going to be $31,500, which is going to give him at $68,500 taxable income. And if his tax rate is 10%, he's going to pay $6,850. So total out-of-pocket money is $22,150. But now let me show you what your savings could be if you had an S corp. The S corp makes $100,000, but with an S corp, you have to pay yourself a fair and reasonable wage. So we're going to put you on payroll, and we're going to put you at $50,000, which a lot of times $50,000 for us is a little high. But if you're a doctor or a dentist, maybe we want to put you here, or maybe a little bit higher than that. So your self-employment tax on that $50,000 of wages is 15.3. But if you ask me, like, where's this 15.3 coming from? Well, it's 6.2% of Social Security, 1.45 of Medicare, and then the company has to match that also. So between both of them, it's 7.65. If you add 7.65 for the company, that gives you the 15.3% that you have to pay, but you're only going to pay on the $50,000, which is $7,600. So now let's do the income tax return. Now you're going to have on line 1 a W-2 of $50,000. You're going to have the additional line 8 additional income from Schedule 1 of $50,000. Your total income is going to be the same, $100,000 total. You're going to get your $31,500 in standard. Your taxable income is $68,500. And now you've got 10% tax, $6,850. So your total tax on this is $14,450. So if you do the 1040 and you're doing a Schedule C, you're going to pay $22,150. With an S corp, you're going to pay $14,450. That's tax savings of $7,700. Again, here's some requirements. You have to have an LLC or a corporation. You cannot do it from a DBA or a sole prop. You can't have more than 100 shareholders. Only individuals, certain trusts, and resident aliens can be part of the S corporation. So if you're a non-resident alien, you can't form an S corporation. You have to file a form within 75 days of the formation of the LLC in order to convert it to an S corp. And there's only one class of stock and pro-rata distributions. Pro-rata just means 50-50, 60-40 percentages of ownership. Your late filing relief, if you don't do it within the 75 days, you have this Rev Prov 213-30, which you have to show reasonable cause. And sometimes we put on there delayed due to administrative oversight by the prior accountant. The reason and the Rev Prov have to be typed on both the cover letter and the actual form. The other thing that we deal with the S corporation is having to do with reasonable compensation. And that is, corps must pay reasonable compensation for services rendered before making distributions. My question is the ratio of compensation to distributions what the IRS looks at? The IRS uses discriminant inventory function system with algorithmic scoring to analyze the ratios and patterns of tax returns. Beware of an S corporation as a partnership, which a lot of people do, have partnerships with other people. We typically like to see a husband and wife to be on the S corp at the most, and because of the pro rata distributions. One of the examples that I have here is, let's just say that I work harder and I want more of the profits for myself. Well, I'm going to have to pay myself more wages, which then causes double taxation, right? In order for me to be able to take out those additional wages, because we're 50-50 partners, right? And thus we're going to pay more self-employment tax. The other one is unreimbursed employee expenses. Well, that doesn't exist anymore. You can't write off unreimbursed employee expenses. But let's just say that you have expenses that you want to deduct for the business, whether it's a truck, a kids, conference, and you know that it's going to benefit your business, but your partner doesn't want to share in the expense to the S corp. So what do? Well, you can't deduct it through here. But we have a solution for this dilemma. We appreciate your interest in understanding S corporations. If you have any questions, need further information, be sure to subscribe to my channel Simplified and follow us on Facebook. And if you want the answer to that dilemma problem, give me a call at the office, 956-451-0793. We'll see you next week.